make sense of all that's been going on, and we've got our technical issues fixed. William Lee joins us, Chief Economist for the Milken Institute. Good to see you again. So I don't even know where to begin on all this, because 2 weeks ago we would be having a very different conversation. So let's get to the banks. Treasury Secretary Yellen, I guess, is giving us a pretty good feel-good moment, because the markets reacted positively to that, saying that things seem to be under control. Do you agree?
Not at all, Phil. I think the supervisors, the bank regulators have made a mess of things. The Dodd-Frank bill that was passed among the reforms after the great financial crisis was that we recognize there are very few supervisory resources, and we got to focus them on the most important banks, the biggest banks, the ones that hold 80% of all the assets in the banking system. And that's exactly what we've done. Unfortunately, that means that the smaller banks will let go, and let go way too much. We see the misjudgments on the part of the Silicon Valley Bank, the bad management, the bad risk management, the absolute inappropriate actions they've taken. And Silicon Valley executives charmed the entire California bank regulators into believing that they were good guys. The San Francisco Fed let them have operations without a risk officer for a year. This is ridiculous. And
okay, look, I think we're all in agreement with you. It is ridiculous, but that said, since we've been doing this, okay, in our careers, we have seen hundreds of banks fail who have poor compliance, poor regulatory, and they make mistakes and they pay the price by failing, right?
No.
Why should this be any different? I mean, it's fine that they fail, right? What's the big deal?
Bingo, and that's exactly the point. If this were a neighborhood bank in a poor black neighborhood whose small businesses were absolutely dependent upon this one bank for financing, do you think we would see this kind of action? Do you think we would see this kind of systemic risk rush to move deposits out of this bank? No, it's because these big depositors, these very rich guys, are pulling the money out, and it's causing these banks to fail, and rightly so, they should fail. Unfortunately, so much of the money is moving around that is causing a lot of volatility in the markets, and because a lot of the stock market is reacting to it, we are suddenly into a world of, my God, the financial system is at risk, and it shouldn't be this way, but unfortunately it is.
So in the age of Twitter, where you and I can tweet to thousands, if not millions of people and say, well, William's house is on fire, everybody get out. Whether it's true or not, I mean, it's literally somebody yelling fire when there may or may not be one. Why doesn't the FDIC, which insures the deposits at all these banks, here's an idea. Why don't they just say that the current insurance is $250,000? Just double it to $500,000 and have the Treasury Department double that to $1 million. So every account's insured up to $1 million. Wouldn't that stem the 99% of the folks who have less than $1 million in banks? They don't have to move their money around anymore, and that would stem the money flow of leaving the bank, which makes them basically insolvent because there's not enough deposits. Wouldn't that solve the problem?
Phil, the regulators and the Treasury is listening exactly to your advice, because that's exactly what they want to do. For the next 2 years, they want to be able to insure essentially all deposits. Now, the question is, when you have insurance, someone's got to pay the premium. Who's paying the premium?
It's 10 basis points. It's 10 basis points to the banks. That's the impact to their profit margin, which, by the way, everyone's happy to pay that right now, because to avoid what we're dealing with in the last 14 days or 2 weeks, I'm sure everybody would be happy to pay that.
You think so, I think so, but those bank executives that are so greedy to improve their profit margins, they were not willing to pay it. And that's really the price that has to be talked about. Who is paying? It's got to be the bank executives and the banks themselves. They got to rebuild their business models in a way that they are still profitable with higher insurance premiums.
There are thousands and thousands and thousands of banks, from Community Bank in New York City to the Bank of Hawaii, okay, on your side of the woods over there. You're telling me there's no way all these banks are in trouble? There's a small group of banks that have made bad decisions and they're in trouble, and I understand that, but isn't it unfair to blanket the entire sector and say, well, everybody's house is on fire now?
It's very unfair. And in fact, no one would care that Bill's house is on fire or Phil's house is on fire, but the fact that it's the venture capitalists and these big investors in California, their house is on fire, then suddenly everyone cares. Isn't that a little weird?
But
that's the kind of culture that we're dealing with.
That's my point, William. Aren't we all overreacting?
Yes, we are. Absolutely. And so is the Treasury. They should have been on the job long ago. The fact that they weren't on the job, shame on them, and they shouldn't be overreacting like this.
All right. I will send this clip to the FDIC and the Treasury Department, and I hope they take your advice. William Lee, always get your analysis. Thank you.
Take care.
Okay.